chairman of the House Ways and Means Committee. However, that proposal does not seem to be really moving, but it did give NAR the opportunity to once again reinforce their belief that the mortgage interest deduction is really central to the health of the housing market and the economy. The other thing that NAR has been working on has been mortgage reform in the form of the GSEs, that would be FHA, Fannie Mae, and Freddie Mac. There was a proposal that came out in March. Senator Tim Johnson, the committee of the Banking Committee, as well as Mike Crapo, who is from Idaho, ranking member of that same committee, released a plan that would phase out Fannie Mae and Freddie Mac over time and replace them with a newly named entity called the National Mortgage Insurance Corporation that would provide explicit federal backing of loans that meet standards of safety and soundness. Now, NAR has been carefully reviewing that plan. It does incorporate many of the principles that association has the association has called for. Top among the main principles that NAR is looking for is explicit federal backing, but that plan does also ensure the continuation of the 30-year fixed rate mortgage and also paves the way for the return of a robust private market for the mortgage-backed securities over time. So once again, this is something that NAR is remaining at the forefront, and Steve Brown, who is the president of NAR this year, actually met with people at the HUD Secretary Sean Donovan at the White House, as well as the head of the National Economic Council, Jeffrey Zients, to basically talk about this reform and ensure that NAR's position would in fact be remain at the forefront of this. All right, and then last but not least, the other issue that has been really major to mortgage is national debt cancellation relief. This is something that NAR has been working on actively. Basically, this is something that they're looking to reinstate. The United States Senate Finance Committee agreed to a bipartisan bill to reinstate basically 50 tax provisions that expired at the end of 2013. Among those real estate provisions was to include extenders package that are relief for mortgage debt forgiveness, 15-year recovery for qualified leasehold improvements, election to expense certain qualified real property and deduct energy-efficient commercial buildings. All these provisions are basically something that would be retroactively extended, and this is something that NAR has been working on this legislation to provide for this. It is something that is hopefully going to continue to move, and NAR will continue to support this extender package as it moves through onto the Senate floor, and they hope for rapid consideration. They're also working with the House of Representatives to take action on this on these provisions that will help millions of Americans. So these are the basic three things that they've really been looking at federally when it comes to mortgage reform and GSEs. All right, and I'm going to hand this back over to Steve in just a moment so that we can have our main speaker come on. So one moment.
Thank you, Erin, for that update. Mason Hodel is here, so we are going to turn the program over to him momentarily. Yep, and let me just find him here. Okay, just bear with us 1 second while we get him available. Okay, more thing, and again, our apologies for our little hiccup this morning, but again, hopefully you found the information that Erin was able to provide regarding NAR's efforts on this important issue. Okay. Okay, so Mason, are you available on the phone? Okay, Mason, can't hear you. Hold on one second. Hello?
Hello?
Just start counting.
Good. Okay, take
1, 2, 3.
I can barely hear him. I don't know why.
Speak up.
1, 2, 3.
I can hear him on yours. I hear him on yours, I think. Okay, our apologies as we're...
Can you hear me on this?
Oh, I can hear you perfectly now. Yep.
Okay.
Okay. You're
All
set.
right.
Thanks again.
All right, fantastic. I want to thank everybody for joining me this morning. Did get stuck in a little bit of traffic, which is sort of perfect for what we're going to talk about today. Basically, expect the unexpected. Today I'm going to talk about a few things that can slow the mortgage process down and what we can all do to try to avoid it whenever possible. First thing, what goes into obtaining a mortgage? First of all, documentation galore, credit, income, assets, appraisals, repairs, and lots of other things. Let's start with the documentation that's going to be required. The loan officer should be sending the borrower a list of income and asset documents to start to gather after the initial phone conversation. This isn't rocket science. We're not trying to launch anything to the moon. Let's start with the basics. We're going to need 2 years' worth of W-2 forms, 2 years of tax returns, 2 recent pay stubs, and 2 most recent months' worth of bank statements for any accounts that are going to be used for the purchase of the property. This at least gives us the basics and a starting point that we can begin the analysis. Let's face it, we all speak a language in our business that the average person just doesn't understand. I try and keep it simple and break down the necessary information into plain English so the borrower knows what to retrieve. During the initial pre-approval conversation, some tough questions need to be asked by the loan officer. We aren't trying to make people feel uncomfortable, but certain things the buyer may say is going to trigger me to look a little deeper and ask even more questions. As long as they know I'm there to help them and give them a solid pre-approval that they can count on, they usually don't mind. The lender's going to find all this out anyway. Isn't it better to get the information up front and deal with whatever situation comes up? When the buyer tells me they're single but have children, I start to ask them more questions. Is there child support either being received or paid out? If the support is being paid out, we need to know about that because it can seriously affect the ability of the borrower to qualify for the mortgage. Is the buyer recently divorced? If the answer is yes, additional items like a divorce decree or a property settlement agreement might be required. If the borrower is receiving child support and it's being used to qualify, it has to be documented. If it's court-ordered, a copy of a printout from Domestic Relations Department would prove both the amount of the support received and the fact that it's paid on time. If it can't be proven the support is paid timely, it can't be used to qualify. Do the addresses between the bank statements, the W-2s, or the pay stubs differ from each other or from where the borrower has reported that they're living? If so, letters of explanation are going to be required. It can be something as simple as that they still use their parents' address, but still an explanation is going to be required. Now, most buyers will be able to provide these items prior to or at the mortgage application. Having these initial documents up front simply speeds the process along. For buyers who may have sloppy record keeping and can't provide the documentation, this is where huge issues can start to happen. This is where we find the surprises. If the lender doesn't have the necessary documentation to submit the loan for approval, They really don't have any choice but wait until the borrower provides it and find the surprises at that point. The buyers become frustrated with the process, and I can't say I blame them. It's scary. Setting the correct expectations up front does help alleviate some of that stress. Letting the borrower know what their responsibilities are, what the lender's responsibilities are, what the agent's responsibilities are, and the time frames associated with accomplishing each task is important. Many times a buyer will send me an email with a bunch of attachments, quickly stating this should be everything we asked for. When we review the information, however, it usually isn't. There may be bank printouts that don't have account numbers or names on them, and they just aren't acceptable. Not going. Bank statements must include all pages of the statement, and if using an internet printout, it needs to show the bank name, the buyer's name, and the account number. If using a bank printout from the bank itself, it needs to be stamped and signed by someone at the bank. The buyer seems to think a lot of times we're asking for the same information over and over, when in reality what they sent wasn't correct. A simple conversation explaining the situation usually calms the buyer down now that they understand. Letting the borrower know not only what documentation is needed, but what information it needs to show can eliminate some extra time and frustration created by having to do things twice. Now let's talk about types of credit and how they're treated. We'll start with mortgages and home equity lines of credit. Does the borrower own any other properties? If so, what are the mortgage payments on those properties? Are they rented out? How long have they been rented out for? Are the taxes, insurance included in the mortgage payment that's showing on the credit report? Is it a condo? Homeowners association fees are rarely, if ever, included in the mortgage payment, but they must be included when we're calculating the borrower's debt ratio. A large condo fee on a property the borrower currently owns could easily increase the debt ratios to a point where they wouldn't qualify for the new mortgage. Documentation to prove that they are either included with the payments or proof of the actual cost of taxes, insurance, and homeowners association fees would be required. Why? All these payments or the negative cash flow from that property needs to be counted when calculating the back-end debt ratio. Installment loans. Usually, any installment loan with less than 10 months left to pay can be excluded from the debt ratio calculation. This is important. If someone's got a car loan that's only got 6 months left, chances are we're not going to count that as a debt against them when qualifying. You have to remember that an underwriter can determine if it seriously affects the borrower's ability to repay the new loan, it can still be counted against them. Revolving credit card debt. Now this is usually counted against the borrower. However, revolving debt can be paid off and if the account is closed prior to settlement. Let me repeat that. It must be closed prior to settlement. The debt does not have to be counted in the buyer's ratio. Now this all takes additional time. Time for the borrower to pay the bill off. Time for the credit bureaus to verify it. Time for the borrower to provide bank statements showing the funds clearing their accounts and the current balance. More documentation equals more time. Student loans, especially student loans that are in deferment. Everybody thinks because loans are in deferment they don't have to be counted. The problem with deferred student loans depends on the type of financing you're looking to use. With conventional mortgages, deferred student loans must always be counted in the debt ratios. It doesn't matter how long the payments are deferred for. FHA allows student loans that are deferred for at least 1 year past the date of the settlement on the new loan. They do not have to be counted. So let me say that again. If the student loans do not come due for 1 year past the date of settlement, they do not have to be counted in the buyer's ratios. So you may be able to make a transaction work by using FHA financing versus conventional financing. Of course, it's good to know this up front. Many times when we're reviewing the credit report, it won't show the monthly payments for the deferred student loans or the dates that they are deferred till. Now again, more documentation is required to either determine the monthly payment or the deferment date. Again, extra documentation equals extra time. Auto leases are a little different. No matter how few months are left on the auto lease, the debt would be counted in the ratios, simply because everybody's aware that the borrower will end that lease and end up in a new lease on a new car. Now, credit, one of the most important things that we look at when analyzing a loan. First of all, has the credit been pulled and has it been reviewed? Are the scores acceptable? When someone tells you their credit is fair, that usually means bad, and bad means terrible. Even a buyer with excellent credit who appears to have money may have an issue. What if they co-sign for their child's student loans or co-sign to help one of their children purchase a home? They sometimes forget to mention this simply because they aren't making the payments. Their children are. A credit report is going to show those loans, and they can be addressed up front with the borrower. Now, if the borrower qualifies carrying all the co-signed debt, it's not an issue. If they don't qualify, then documentation is going to need to be provided to prove that the other party is making the payments. 12 months of canceled checks from the other party to prove the payments were made by them would be required. The fact that the debt's paid on time can be verified by looking at the credit report. Again, more documentation equals more time. Most lenders have a minimum score they'll approve a mortgage at. 640 is what most, but not all lenders use. Some lenders will go down to a 620 or even lower on a case-by-case basis with additional overlays. Overlays are nothing more than different guidelines that each lender may apply for loans in this credit range score. They may require an extra down payment or more liquid funds after closing. Are there judgments or liens showing on the credit report? Even if the scores are acceptable and good credit's been reestablished, these judgments and liens are going to need to be paid in full because they can attach to the new property. Does the borrower have enough money to pay these off and still have enough to complete the transaction? This is all information we need to know up front. Bankruptcies. Are there bankruptcies showing on the credit report? Are they a Chapter 13? Are they a Chapter 7? If so, different waiting periods exist for different loan products. They're always going to look at the inquiries on a credit report. And inquiries are nothing more than a list of companies that have checked into the borrower's credit in the past 120 days. A letter explaining why each company checked the borrower's credit and if any new credit was open is going to be required. Why, you might ask? The lender is trying to determine, are there any additional monthly obligations that we aren't aware of that could affect the debt ratios and the borrower's ability to repay this mortgage. Credit explanations might also be required to address any derogatory credit that appears on the report. Again, more documentation equals more time. Don't open up any new credit. I know this sounds pretty simple, but you'd be surprised how often it happens. Lenders will do what's called a soft pull of the buyer's credit a week or so before closing. And what they're looking for are any new inquiries on the credit report. They're going to double check and make sure no additional credit accounts have been opened and additional monthly payments obtained that could affect the borrower's ability to repay this mortgage. It's a classic example. Here we go. It's 5 days before closing. The loan is already clear to close. We do the soft pull. Raymore and Flanagan shows up. The buyer went and bought furniture for a home they don't even own yet. Now everything comes to a screeching halt. Now we have to verify that the borrower did open a new credit account. Verify the payment. Since it's so new, the borrower probably hasn't gotten their first bill yet, and they don't know what the payment is. Now we're off to the credit bureau to call the company and verify the payment. A day goes by. We have the payment verified. Now, assuming this additional monthly payment didn't knock the borrower out of qualifying, which it very well could have if the ratios were really tight to begin with. Now we're back running it through the automated underwriting system, back to the underwriter for a clear to close. This simple event probably costs 3 to 5 days in the closing of this loan. It's why it's so important to have this conversation with the borrower up front and let them know, do not open up any new credit. All right, now income verification, all part of the analysis of the mortgage loan. Now when a buyer says they've been on their job 2 years, is it really 2 years? Or is it 1 year and 10 months? It matters. The 2-year work history is required. Now, as long as that borrower who was on his job 1 year and 10 months was employed at a prior position without any huge gaps, this would probably be fine. If there were large gaps in the employment, it could still be okay, but again, letters of explanation are going to be necessary to explain the reason for the gaps. Was the borrower injured or on maternity leave? Were they laid off due to the economy? Again, more documentation equals more time to get that transaction to closing. Is the borrower recently out of college and only on a job for a few months? It's perfectly acceptable, but a copy of school transcripts or a diploma would be required to document the attendance of the school. The probability of continued employment would need to also be verified. Again, a little more documentation. Or taxes taken out of their pay. There are certain lines of work that are notorious for not taking taxes out of an employee's pay. Home health aides, waitresses, bartenders, tradespeople, and that's just to name a few. A little red flag goes up in my head when certain employment types are mentioned, and I'm going to start digging a little deeper and asking some more questions. Perhaps their employer pays them a 1099 at the end of the year. Now this basically makes them self-employed, even though the borrower may not realize that. I recently closed a loan where the borrower worked for his brother's company. The borrower paid him as a 1099 employee. The borrower didn't use an accountant, filed his own tax returns, and just put that income on the W-2 line. Now we were able to close that loan, but not without some detailed explanation letters to try and explain to us why it was filed that way. Now as long as the income is claimed on the tax return and we can document a 2-year history, it can be used to qualify. If the income cannot be documented, it can't be used. Cash, tips, under the table income. Does the income the buyer is telling you they make, does it include overtime, bonuses, commissions, part-time or seasonal income? These not only need to be verified as likely to continue, but according to the guidelines, they need to be averaged over a 2-year period. Are they union employees? If so, not only does that income have to be averaged, but there could be some other surprises. Do they write off unreimbursed business expenses for things like dues, tools, clothing, mileage? If so, this all must be deducted from their base incomes. Is the borrower self-employed? Now, I can't tell you how many times I've had a self-employed individual on the phone, and when asked how much they make, they'll tell me $100,000. After I review the tax returns, it's usually a third of what they think. Lenders will only use the income after all expenses for the business have been deducted, and even then they're going to average that over the past 24 months. The lender is going to use the adjusted gross income for qualifying purposes. Sometimes that income that the lender is going to use may be drastically different from what the buyer and the realtor thinks it is. Are they union? Are they self-employed? If so, it is impossible to determine what income will be used to qualify without reviewing the last 2 years' tax returns. And all of a sudden, what everybody thought was a qualified buyer from an income standpoint turns out to not qualify, or makes it necessary to switch to another program that would allow higher debt ratios, such as FHA. Now, a new appraisal is needed. Endorsements need to be done for the agreement of sale. Possible repairs required as a result of the switch. Again, more time wasted that could have been avoided by having a full pre-approval done up front. Additional documentation will be required for the self-employed borrower. A year-to-date profit and loss statement may be required. Usually a letter from a CPA to verify the borrower's been in business for a minimum of 2 years would be required. So again, this additional documentation takes more time and can certainly slow the transaction down. Avoid job changes. I know this sounds simple, but again, if at all possible, buyers should try to avoid getting new employment right before or during the mortgage application. Believe me, I've seen it happen. In cases where it's just not avoidable, it's not always a problem, but it can be if the new job has a probationary period and the lender is made aware of it. Many companies have a 90-day probationary period for new hires. Basically, they can be fired for no reason during that time. If that's the case, the new job has a probationary period, you're not going to be able to close that loan until after the probationary period is ended. Even where there's no probationary period, the new employer is still going to have to be verified, and usually a pay stub from the new company is going to be required. Since it can take 2 weeks or more to get that first pay stub, this can certainly delay a closing. Lenders will do a verbal verification a few weeks before closing to verify the new job, or the current job, I should say. You will not get away with a new job without the lender knowing. Assets. This is one of the biggest problems I see. It can be a major issue when you're processing a loan file. If the borrower has one checking and one savings account, you may not have an issue. But when someone is using many different accounts, it can be a downright nightmare. As a lender, we're going to ask for the 2 most recent account statements for any accounts being used for the purchase. Again, the bank statements must include all pages to the statement, and if using internet printouts, they need to show the bank name, the buyer's name, and the account number. If they went to the bank and got a printout from the manager, that needs to be stamped and signed by someone at the bank. One of the biggest things I do see is bank statement will be 6 pages long. They'll send in 5 out of 6 because the last page was their doodle page, or where they balance their checkbook. What everybody has to understand is the lender doesn't know that that is the doodle page. They need to see all 6 pages, even though it doesn't sound like it makes sense. Now, any large deposit over and above the borrower's net paycheck can be called into question, and documentation be required to prove where these funds came from. As a lender, we know the borrower's net paycheck. We're looking at their stubs. And since most people use direct deposit, it's pretty easy to see. This can be prevented from the beginning. You need to have these conversations with the buyer as to where the money's coming from. Excuse me. Let's say you have a buyer that's 30 years old and they save $5,000 for a purchase, but they need $10,000 to complete the transaction. When you ask them where the rest of the money's coming from, they'll say, we're going to get it or we're going to save it for closing. Now, I'll give them the benefit of the doubt and consider they just started working and earning a decent salary 5 years ago. If it took them 5 years to save the first $5,000, what's to lead me to believe they can save another $5,000 in 60 days? If I did the math, it would follow. It would take them an additional 5 years. So what's changed that the borrower would be able to save so much in such a short period of time? Probably not much, and chances are there's going to be some sort of large deposit into that borrower's account prior to closing. The best advice is to try and get as much information as possible up front. Where is the money for the down payment and closing costs coming from? Is there going to be a gift from a family member? If so, not a problem. It just needs to be documented correctly. We would require a gift letter signed by the donor, a bank statement from the donor showing the money clearing their account, a copy of the check, and an updated bank statement from the borrower showing that the gift was deposited in their current account and the current balance. This all takes time. Again, if the proper expectations are set up front with the buyer, they can start this process at the beginning of the transaction and not a week before closing. What if the borrower is selling an asset like a car, jewelry? Again, this isn't an issue if this is known up front. We would need proof of owning the asset, a copy of a bill of sale, and documentation that the money was deposited into the borrower's bank account. I recently had a buyer who sold an antique car for $25,000, cash. He was using it for the down payment and closing costs. I reviewed the documentation with him. He gave me a copy of the title to prove he owned the car, a a copy of the bill of sale, and proof the money was deposited into the borrower's account, and it was fine. Let's say you're working with a nice young couple. They're going to get married. They're using wedding money for the down payment and closing costs. Again, not an issue if it can be documented correctly. You can't possibly trace all the cash and checks they might receive at a wedding, but a copy of a marriage license and a wedding invitation would probably do the trick. Many borrowers now use online accounts like Capital One 360. They move money fast and furious between there and their regular checking accounts, all to get a few more pennies interest. They'll move the first $1,000 for the initial deposit. Then they'll move the second deposit. Then they'll move the $400 for the home inspection, and so on. Well, every time these deposits show up in the other checking account, the lender's going to ask for proof where it came from. So they've just created more documentation, which takes more time. I always ask them, why do they do this? And chances are they'll tell me that they're making extra interest on that account. Really, that account's probably paying 1%. 1% on $10,000 equals $100 a year, or about $8.33 a month. Move the money all at once. I'll even pay the $20 to keep it that simple. Don't allow your buyers to deposit cash in their bank accounts. This is a biggie. I understand that sometimes grandpop or grandmom might have $2,000 in their sock drawer and want to help out their grandkids, but it has to be documented with a paper trail and treated as a gift. Any cash where the source can't be verified will simply not be counted towards the borrower's funds for down payment and closing costs. You could literally have a borrower who has $20,000 in their account that they put in as cash, and if it can't be documented, the loan can't close because as far as the lender is concerned, they lack the necessary funds. Now let's talk about 401k plans. Again, there's a little difference between an FHA loan and a conventional loan when it comes to using these types of plans. If the borrower is borrowing from a retirement plan to complete the transaction and using conventional financing, the payments on that 401k loan must be counted in the debt ratios. With FHA, they're not required to be counted. Again, knowing this prior to writing the agreement of sale, which type of financing the borrower qualifies for, eliminates the possible need for program changes in the middle of transaction that would cost both time and money and slow the transaction down. If they are using funds from a retirement plan, the lender is going to require proof. First of all, the value of the account, proof the funds were borrowed or liquidated, proof of the balance in the retirement account after the funds were taken out, and proof that these funds were deposited into their regular checking or savings account. The process of borrowing against or liquidating funds from these types of retirement plans takes time. It doesn't happen overnight. It can take 2 or 3 weeks. This is something the borrower should be working on right away. Again, not 2 weeks before the closing where you're going to have an issue. Again, more documentation equals more time. Now, buying a new home without the current home being sold. Recently, and it's kind of funny, the last 3 loans I wrote, the buyer was either trying to sell their current home after settlement on the new house, or they plan to rent it out after closing on a new house. The guidelines for both conventional and FHA state there needs to be 30% equity in the property the borrower is leaving behind to be able to count rental income from that property. Again, 30% equity in the property they're leaving behind. If they don't have 30% equity, the borrower has to qualify carrying both the new housing payments as well as the old housing payment. An appraisal on the current home may be required to prove the 30% equity position. This takes extra time and money. If known up front, that can be allowed for. In the cases of the loans I did, neither had the 30% equity required in their current homes, and I couldn't count any rental income. Fortunately, they qualified carrying both the old and the new payment. But one item of importance to remember, the lender is going to be looking for reserve monies. They'll want to see the borrower has funds left over after closing equal to 3 to 6 months of mortgage payments, not just on the new property, but the current home they're leaving behind as well. This can add up to quite a sum of money, and fortunately, I was able to use their 401k plans as reserves. But in order to do that, the borrower has to be able to prove how and when these retirement funds can be liquidated or borrowed against in the case of an emergency. There are certain types of retirement funds out there that borrowers just can't access. And if that's the case, and the fund can't be borrowed against or liquidated, it will not be counted as reserve money, the transaction will not meet guidelines, and the mortgage could be declined as a result. Again, information up front so that we know what we're doing from the very beginning saves time and can save your transaction. Let's talk about appraisals. I'm not an expert, but did you just sell a property where the condition might not be the best? Were appliances missing? Were the utilities turned off? Are there holes in the walls? I've seen it all. Is it a HUD repossession or a bank foreclosure property? Give your poor loan officer a heads up. If the property's in rough condition or no utilities were on at the time you showed the property, let your loan officer know. If the appraisal inspection reveals that any of these situations exist, you've just created an extra step in your transaction. Now the appraiser will either have to go back and reinspect, or certification for water, electric, heat, hot water will be required. Now if you do have to provide certifications, you want to be sure of a couple things. A, they're from a licensed contractor, plumber, HVAC person, that the certification's on their letterhead and has their license number on it, and that the certification is signed. Most lenders will not accept the certification if all that information is not there. So again, if they don't have the information on them, it just has to be done again, and that wastes more time. So now we've added a few extra days in expense to obtain these certs or the re-inspections to the transaction. Had the loan officer been told up front what they were dealing with, he or she could have advised that the appraisal be held off on until the utilities could be turned on, and possibly eliminated the need for those items. You should counsel your sellers as to what repairs might be called for. If they've recently accepted an FHA offer and you know the house has a lot of chipped and peeling paint, you might want to let them know that scraping and painting is probably going to be required by the FHA appraiser. Start getting these estimates for the work now, not a week before the scheduled closing. Are there stains in the second floor bedroom ceilings? If so, a roofing certification may be called for. And even if the roof was repaired or replaced, the stains are still there. The sellers will be well advised to paint those ceilings. Again, more time, more documentation, and more aggravation. Is the property a flip? Did the current owner purchase the property in the last 90 days? If so, the lender may have certain requirements. A second appraisal may be required. And did you know on an FHA loan the borrower cannot be charged for the second appraisal? Who's going to pay for it? Seller? Agent? Loan officer? Is it a short sale with no bank approval? You need to let your loan officer know so they have an idea of what they are dealing with before they get started. Now, just because an appraisal comes back at value with no repairs doesn't mean there isn't an issue. After being reviewed by an underwriter, there may be additional conditions required, such as additional comparable sales, explanations from the appraiser as to why one comparable sale was used and not another. And while it's rare, repair conditions can be added. You have to remember there's also computer valuation estimates being run in the background. If an automated valuation system indicates the value the appraiser brought the property in may be too high, I can guarantee you it's going to be looked at very, very closely. If there are repairs called for, the reinspection by the appraiser needs to be scheduled prior to closing. It all takes time. The sooner the appraisal is ordered, the sooner everyone will know that there is or isn't an issue. I seem to have been lucky lately, and I'm probably going to jinx myself, but I haven't had issues with low appraised values in a while. If an appraisal does come in low and the listing agent wants to appeal that appraisal, that's fine. It's not a problem. First thing we're going to ask is that the listing agent provide comparable sales that the appraiser, for whatever reason, may have missed. It happens sometimes. Everybody makes a mistake now and again. If we have solid comparable sales, we have a shot at appealing the value. With no comparable sales to support that value, there isn't much anyone can do but assume that the appraiser is correct. Now I'm going to talk about for a second a quick closing agreement of sale. We all do it. We all get 30-day agreements of sale. The buyer's anxious, the seller wants to move quickly, and the agreement's been written to please all parties. Now when an agent writes a 30-day agreement of sale, it may take 5 days to negotiate the final sale price, 5 days to get a home inspection done, and yet another 5 days for the repair issues to be negotiated. That's already 15 days out of a 30-day deal, which a single date for commitment or settlement wasn't changed. The buyers are very reluctant to make the full mortgage application, especially to pay the appraisal fee, until they're sure they're getting that particular house. Now, even though the agreement of sale states they'll make a full mortgage application with 10 days of the seller's acceptance of the agreement, it doesn't say 10 days after repairs are negotiated. A high percentage of buyers are out of contract by the time negotiations are complete. I know as loan officers and you as real estate agents, we work crazy hours. We work nights. We work weekends. You have to remember, processing staff at a mortgage company, they're normal people. They work 5 days a week, usually 9 to 5, although plenty of overtime's put in. So your original 30-day deal was really 20 working days to the mortgage company, of which 15 were eaten up before the actual application process started, leaving 5 working days to process, approve, and close a loan. Even with a very simple, clean buyer, that's going to be very tough. With a complicated borrower that may have to produce additional documentation, it's an extremely difficult feat to accomplish. I'm not saying it can't be done. It just puts everyone involved in a stressful situation. Had the buyer completed his application or done a full pre-approval, especially within the first 10 days, and provided 90% of the income and asset documents needed, it would have made this transaction much easier. Let's talk about flood zones and flood insurance. Did you know every home in the United States is in a flood zone? It just depends on what zone the property is located in, whether flood insurance is required. Flood insurance takes time to obtain. Most times an elevation survey is going to need to be done for the agent to be able to quote the policy correctly. The lender is then going to compare the elevation survey to the flood policy to make sure the quote is accurate. Most times the agent and the seller will know the property is in a flood zone, but many times won't. I have a transaction. I closed it last week. It was an estate sale. The sellers lived there for 40-plus years, never had flood insurance, and hadn't had a mortgage on the property in years. The heirs to the estate didn't know it was in a flood zone either, nor did the listing agent. Everybody knew that there was a creek at the rear of the property, but it was down 8 feet, and it ran through a concrete waterway, and it was about 2 inches deep. Who would have thought it was in a flood zone that required insurance? Well, guess what? We did the flood certification and determined it wasn't a zone that required flood insurance. Fortunately, the elevation survey showed that the house sat pretty high in relation to the creek, and the cost of the flood insurance wasn't too expensive. The seller did reduce the sale price by almost $15,000 to make up for the cost of the flood insurance the borrower had to pay for the 30-year term. In this case, the transaction fortunately worked out well for all parties. The buyers got a better deal, and the estate really just wanted to be rid of the property. So if it's determined that a property is in a zone that requires flood insurance, the borrowers need to know this right away and act immediately to get this insurance in place. It takes time and can slow down your closing. If you've shown someone a few houses and asked them to call your loan officer and get pre-approved and they haven't or won't, you may have a problem there. Everybody needs to realize what lenders have to do to get a loan approved and closed in this environment. Lenders are under fierce pressure to close loans on time, but the back office list of items that need to be verified just keeps growing and growing. Now, I know I haven't covered every possible scenario, and that's why I love what I do. It's always a surprise and something new on every deal. All the things we talked about can and will slow down a closing. There are just too many moving parts in a real estate transaction anymore. All we can all try and do is get as much information up front about the buyer before writing the transaction, let the buyer know what documentation will be required so they can move quickly to obtain these things. The best advice I can offer is pre-approve, pre-approve, pre-approve. Every one of your buyers should be pre-qualified through a lender you trust to get the information needed up front to ensure that you have an accurate pre-approval. As a loan officer, you have to think like an underwriter when you're taking a loan application. If that loan file gets to the underwriter and something doesn't make sense, you've got a problem. More documentation will be required. Remember, it's the loan officer's job to ask the questions that lead to more questions, that lead to yet more questions, that turn a pre-qual into a pre-approval. I want to thank you all today for taking time out of your busy schedule and attending and listening. I hope you found the information helpful. Thank you.
Thank you, Mason. Great job. Now, with the time we have left, we'll take questions from our listeners. If you wish to ask a question, please signal by clicking the Raise Hand button, which is found below the participant list on the right-hand side of the screen. When we acknowledge you, your location will be unmuted so we can hear you. Please, only one person at your location should speak at a time, and preferably the person closest to the phone. After the question is asked, your location will be muted again while the answer is given. You can also ask your question by typing it into the question box in the lower right-hand corner of the screen. We'll try to get to as many questions as possible in the time remaining today. And note that if you do have questions regarding what Erin had spoke about earlier regarding NAR's legislative efforts on mortgage reform, she is back with us and she can answer those questions as well. So again, if anybody has any questions, please either again use your raise hand feature, or you can type them in using the question box on our right-hand side of our screen. Okay. We do have one question, it looks like, so let's get to that. Actually, just a comment from Andrew. Again, great presentation, excellent overview. Thank you. Thanks, Andrew, for your comment. So let's go back here to our attendee list and see again if anybody's raised their hand. Again, Mason can answer any questions regarding what he had spoken about, or Erin is available again regarding any legislative questions you may have regarding mortgage reform. Okay.
No questions.
Somebody has to have a question.
Couldn't possibly have done that good of a job. Somebody has to have a question.
I'll give it another minute or so just in case something pops up here. Oh, we do have a question, and this is going to be from, I just saw it. Oh, I thought somebody had raised their hand. Now again, you can use the raise hand feature, or you can use the question box to type in your question. Oh, okay, we do have another one, so let's get to it here. Okay, this question is from Christy Wolf, and she asks, Mason, you mentioned that a borrower needs 30% equity to qualify for a new loan when using a property as a rental. Does the rental need to have tenants to be counted as a rental?
Now, that question depends on two things. Is it their current primary residence that they're leaving behind? Now, if that's the case, then you need the 30% equity position in there a lease, most likely they're going to want to see a copy of a check from the tenant, see it deposited into the borrower's bank account, so we can really prove that this property is actually rented out. If it's a current investment property that they've owned and they've owned for a couple years, then hopefully that is rented out, and that 30% equity rule would not apply. So that only applies to a current primary residence they'd be leaving behind.
Okay. Okay. Anyone have any additional questions? Christy, thanks you for your answer. Again, you can use the question box on your right-hand side or use the raise hand feature. And again, we can unmute you and you can answer the question over the phone, or if you have a voice over IP over your computer. Any additional questions? Okay, again, Aaron's here if you have any legislative questions, or Mason can answer any questions regarding his presentation. Oh, got another one. This one is from Staniel Saunders. Are there any options for buyers that are full-time waitresses?
Sure, absolutely. Again, it depends on what that income is. I mean, if it's W-2 income as a base and they claim the tips on their tax returns, then we can use whatever income that we can verify. The only income that couldn't be used in that situation would be anything that would be cash that wasn't reported on the tax return or W-2 form. So sure, if someone's got a full-time job, they're making whatever is a base income, they claim 50% of their tips, we could absolutely use that income to qualify.
Okay. Thank you. Any other additional questions? Again, use the question box feature or the raise hand feature. We have one from Mike Tercy. I have a seller with a property on a pond, owned by them for 24 years. Never had to have flood insurance and no problems. Should they be concerned?
Until a flood certification was done, I would be concerned. You just don't know anymore with FEMA redoing these maps what's going to fall into that zone that's going to require the flood insurance. A lender should be able to get that for you. Should be able to order one ahead of time, and you can make that determination whether that property is in a flood zone or not.
And this is Erin. I'll just add, too, that property owners have a couple of resources that they can kind of look into ahead of that mortgage application. Floodsmart.gov as well as FEMA.gov are two really great places where they can get more information about flood zone determination, as well as information about things called letters of map amendments, which basically, if they do feel that their property has been improperly put into a high-risk flood zone, they can actually go and get an amendment to that flood zone map and get themselves out of it. There's also some information about FEMA's programs on NAR's site as well. Certainly, this last year with some changes to the program, where suddenly there were some rate increases, which, by the way, thanks to a recent legislative action, has been delayed for a few years. There were some issues that were coming up in our area as well, having to do with changes to that profile for properties that were in high-risk areas. So it's a good idea for you to give those resources to your consumer so that they can be more aware of what's happening with their particular property.
Thank you, Erin. Any additional questions? Again, use the question box, or you can use the raise hand feature. Mike thanks both Mason and Erin for their answers. Any additional questions? Again. Okay. So I guess as we wrap things up here, we will be sending out a evaluation of today's program via email, so just keep on the lookout for that. And as with all of our webinars, we do record them and do post them on our website. And there'll be a link in your email that you receive for the evaluation that takes you right to the archive page. Hopefully we'll have that up later today or tomorrow at the latest. So again, if you want to revisit some of the information that was discussed on today's webinar, you can do so through the archive. As always, we appreciate your participation in our events, and again, that's why, again, we want to hear back from you and as much as we can from how we did today. And we hope to have you available for a future webinar or one of our seminars here at the association. So again, thanks for your support of Suburban West, and thank you again, Mason, for your great efforts today, and thank you, Aaron, for stepping in and providing some legislative updates as well. So thanks again, and have a great rest of the day. Thank you.
Thank you.